In the second quarter of 2026, the investors in one American fund asked for $2.4 billion of their money back. The fund had $25.9 billion of loans sitting on its books. It sent back around $700 million and closed the window until the next quarter. The fund is Apollo Debt Solutions. 16.8% of its shareholders asked to leave. 5% were allowed to. 3 months before that, investors in Blue Owl's funds asked for $5.4 billion back in a single quarter. In one of those funds, 41% of every share outstanding. Blue Owl let 5% out. In June, Blackstone's private credit fund did the same thing at the same number. And the market these three funds sit inside is worth somewhere between $1.5 trillion and $3.5 trillion, depending on which institution you ask. Split the difference and you land at about $2.7 trillion. The gap between the highest estimate and the lowest is $2 trillion on its own. That is not a rounding error. That is a market the size of a G7 economy that nobody can locate. For a decade, this industry sold one sentence to its clients: losses here are close to impossible. On the 17th of May 2007, the chairman of the Federal Reserve said of subprime mortgages that he saw no serious broader spillover to banks or thrift institutions. 15 months later, Lehman Brothers no longer existed. So what is private credit actually? Why are serious institutions now putting it in the same sentence as 2007? And why does a market almost nobody outside finance can define already have a claim on a retirement account that might have your name on it? By the end of this video, you'll understand exactly how the money travels from a locked fund to an ordinary pension, and why the region that currently looks safest is where the next version is quietly being assembled. None of this is secret. It is in the fund's own filings with the Securities and Exchange Commission, in a Financial Stability Board report published on the 6th of May 2026, in FDYC lending data going back 15 years, and in a Department of Labor letter dated the 30th of March. It has just never been put in the same place. The obvious explanation is panic. Headlines got scary, wealthy investors got nervous, everyone reached for the exit at once. That explanation is wrong, and the timing proves it. The discount came first. By the end of March 2026, LSEG data showed the median listed business development company trading at 0.74 times its expected net asset value. 26 cents of every dollar gone. The steepest gap since October 2020. Investors did not run and then create a discount. They saw a discount that had already been sitting there for months and worked out what it meant. To understand why that matters, you have to understand why any of this was built, and the honest answer is that it was built for good reasons. 3 conditions created private credit, and all 3 were real. The first was regulation. After 2008, banks were told to hold far more capital against risky corporate loans, so they stopped making a lot of them. A mid-sized manufacturer that wanted $40 million to buy a competitor stopped being a customer and started being a compliance problem. That company still existed. The demand did not go away. It just went looking for a different lender. The second was interest rates. Almost every one of these loans is floating rate. The interest resets with the central bank. In the Apollo fund, 96% of the portfolio floats. When rates rose, the yield on these loans rose with them, and funds began paying out 9, 10, 11% a year, while a bank savings account paid a fraction of that. Apollo's flagship share class was distributing at an annualized rate of 9.05% as recently as June 2026. Money moves toward that. All money does. The third condition was the one that changed everything, and it is the one that closed the trap. Somebody worked out how to sell these loans to individuals. Here is the structure, in plain terms. A business development company is a pot. Wealthy individuals put money in. The pot lends that money to private companies. The loans cannot be sold quickly because there is no exchange, no ticker, and no daily price. But the pot promises that once every 3 months you can ask for some of your money back, and the pot will buy your shares. There is a limit written into the documents, typically 5% of the fund per quarter. That limit is not fine print anyone hid. It is on page 1. And for years, none of it looked reckless. Look at what Apollo actually owns. 405 portfolio companies across 57 separate industries. 99% of it is first lien debt, meaning if a borrower fails, this fund is first in the queue for whatever is left. Loans not being paid at all, non-accruals, sit at roughly 1% of the portfolio. That is a diversified, senior-secured, high-yielding loan book. Someone building a case that private credit was a genuine improvement on bank lending has a real case to make. Which brings the obvious objection, and it is a good one. This is not a bank run. Nobody was promised their money on demand. The 5% gate is contractual, it worked exactly as designed, and every investor signed a document saying they understood it. All of that is true. And it is precisely why hitting the gate is the signal. A limit nobody ever reaches is a formality. A limit 3 of the largest firms on the planet hit in the same 6 months is a QE. Stop for a second and think about what that queue looks like from inside Blue Owl. Investors ask for $5.4 billion in 3 months. The fund is holding $11.3 billion in cash, credit lines, and liquid assets, genuinely a lot. It pays out under $1 billion, which means the $11.3 billion was never the problem. The problem is what happens next quarter, when the people who were refused come back and get in line ahead of everyone else. So this is a bad year for wealthy investors who signed a document. That is where the story is supposed to end. Except the wealthy investors were never the ones actually holding the risk. Follow the money one layer back, and it stops being a story about private clients almost immediately. Start with the banks. According to FDIC data, U.S. banks had lent over $1.4 trillion to non-depository financial institutions by the end of 2025. That category is mostly private credit and private equity. In 2010, that lending was less than 1% of the bank's total loan books. By the end of 2025, it was around 11%, a rise of 2,320% in 15 years. The largest single lender is JP Morgan, then Bank of America, then Citigroup. Banks did not stop making risky corporate loans after 2008. They stopped making them directly. Then the insurers. The Financial Stability Board found that life insurers now hold roughly 10% of their portfolios in private credit, and that private equity-backed insurers control around $900 billion of insurance liabilities in the United States alone. An insurance liability is not an abstraction. It is an annuity. It is a monthly payment somebody is planning to live on. And then there is the accounting. Around 12% of private credit loans carry a payment-in-kind feature. In plain terms, a borrower who cannot afford this quarter's interest in cash is allowed to pay in more debt instead. The loan gets bigger. The fund records that increase as income, and the fund can then pay that income out to investors as a distribution. Nothing has been earned. Nothing has been received. The borrower is in more trouble than last quarter, and the investor gets a check. Now put 2 numbers side by side. The funds report non-accruals of about 1%. Fitch Ratings put the default rate for private credit institutions at 5.8% in January 2026, the highest since August 2024. Both can be technically accurate at the same time, which tells you something uncomfortable about what the word default is doing in these filings. And the market has already answered the question. Boaz Weinstein's Saba Capital has been making offers for stakes in private credit funds at 20 to 35% below their stated net asset value. Blue Owl's listed vehicle was trading around 20% under book when a merger collapsed in November 2025 and around 25% under by April 2026. As one valuation firm put it this year, if an asset cannot readily be sold at net asset value, then net asset value is not fair value. None of this means the system breaks next month, and it is worth being careful here. The mechanics are not those of 2008. These are senior secured loans to operating businesses, not repackaged mortgages sliced into instruments almost nobody understood. Outright defaults are still running around 1%, roughly 5% when selective defaults are counted. Where regulators can identify bank exposure separately, it sits under 0.5% of bank assets. The Financial Stability Board's own report says plainly that the data is incomplete. That is the finding, not a caveat on it. The honest position is not that collapse is scheduled. It is that the sector, in the words of the FSB, remains untested by a prolonged downturn, and nobody has a complete map. So here is the answer to the question in the title. This is worse than 2008 in one specific respect, and it is not the quality of the loans. It is that in 2008 the bad assets had a price, and everybody could see it falling. Here, the price is an estimate produced quarterly by the same firm that owns the asset, and when investors tried to convert that estimate into cash, 3 of the largest managers on earth said no. And the one number held back until now is this. On March 30th, 2026, The U.S. Department of Labor issued guidance opening 401k retirement plans to private assets, including private credit. Trustees who follow the process get legal protection from being sued for it. Senator Elizabeth Warren's objection was that it would expose retirement plans to risky assets at a time when prices are falling. The gates went up at Apollo 3 months later, which means private credit was never really the story. The story is what happens when an illiquid asset is sold with a liquid wrapper, and the wrapper is what gets bought. That pattern is now moving east, and it is already on the record. The Financial Stability Board found that Asian banks, Japanese banks in particular, have been increasing their lending to private credit managers based in North America. Asia Pacific's own private credit market is smaller, around $59 billion in 2024, forecast to reach $92 billion by 2027, with 90% of deals made to borrowers with no private equity sponsor behind them at all. Japan's authorities said in April 2026 that they saw no major domestic risk from private credit, for now. And in Apollo's own filing, the split is right there. Onshore investors asked for 4.3% of their money back. Offshore investors asked for 12.5%. The money furthest from the fund ran first, and it ran 3 times as hard. Distance from Wall Street is not the same thing as distance from the risk. That's what this channel does. Take numbers that are already public and put them next to each other. Subscribe if you want the next one. And if you have ever been sold something described as safe and only later found out what was inside it, put it in the comments.